Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Nvidia. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today we're going to look at Nvidia, but before we get too far along, we actually see some things in the S&P 500 index chart that are worth mentioning. It's been a while since we've really been able to look at the chart because it's been so ugly recently. A lot of chop in the marketplace, a lot of volatility in the marketplace. But last week we talked a little bit about this trend line that I'm going to highlight on the chart here, and that we had a breakout and a solid breakout in that. And we've seen a lot of solid green bars to the upside ever since we had that strong move, that strong breakout. We're seeing the 200-day moving average starting to line up a little bit here. And not to mention, we actually broke above the 200-day moving average today. Would be really good if we actually closed above that at the end of the day and we stayed strong going into this week. So for the first time in a while, the chart actually looks interesting as far as the S&P 500 index is concerned, if you are a bull on the marketplace. Let's put it that way. So if we turn to my VIX watch list, let's run over there just for a second. We see that the VIX is down. It's down around 23%. I still personally am surprised that we're not actually a little bit higher on the VIX index, considering the geopolitical concerns, rising inflation. And speaking of rising inflation, we also have the 10-year actually blowing away. And I'm going to highlight this on my small chart here inside my VIX watch list. And we see that the 10-year has blown through the 2% range. So this is the TNX index. That is the index that tracks the interest rates put out by the Chicago Board Option Exchange. And we were highlighting quite a while ago how long it has been since we saw the 10-year bond trade higher than 2%. And it was going all the way back to 2018. We see now that we are above that range, and not only are we above it, once we really broke out, interest rates just started to skyrocket, for lack of a better term. So you move the decimal 1 point, and that tells you where the interest rate is at. So 23 means 2.37 is where the interest rate is on the 10-year. This was obviously after the Fed meeting, they were fairly strong about what they're going to do going into the end of the year. They're looking at maybe 6 or 7 rate hikes. They raised it 0.25%. I think they really wanted to raise the interest rate a little bit higher, but with the geopolitical concerns going on, it was really hard for them to do that. Probably should have acted previously, only because you could kind of see that Russia was about ready to invade Ukraine. It was really hard to sell an interest rate hike after the event has happened. Obviously, because of this and all the sanctions, it does not help the inflation picture. But with all that said, we have a lot of green bars on that S&P 500 index chart. If I look at the sectors, let's see what's going on with the sectors. I'm going to go to the S&P sector ETF watch list, and we see that financials are up, which would make sense with interest rates, with the yield curve helping out a lot of the banks and a lot of the financials. But one thing that is interesting is to see energy down. So we have oil down today, and a lot of the energy companies, which have had a really good run recently, are giving back a little. So the XLE is down about 1.5%. Well, we got the XLF up about 1.7%. So got a little give and take going on with the financials versus the energies. All right, so today we are semi-interested in Nvidia, which is the title of our video today. And that has a little bit to do with the chart also. So I'm going to run on over and we're going to look at the chart for Nvidia. And it's an interesting chart, but I'd like to see a little bit of follow through on the chart. We're bumping up against a resistance area in Nvidia. Just like the marketplace, it screamed through the 20-day moving average, blew away the 50-day moving average, had a real strong move to this gap area, right around 269 and a half, we'll call it. We'll round up to 269 and a half. But this was a big gap up that happened back at the beginning of November in 2021. So if the gap needs to be filled, this would be a very interesting area on the chart, but we haven't completely broke out to the upside. So ideally, I'd like to wait maybe a day before I consider this trade, but guess what? We tape the stock play of the day at Tuesday at noon. We do it live. So we're in just an interesting area on the chart on Nvidia. So we're going to use options just like we did in Google not that long ago. We're going to do a wide long call spread today to almost a fear of missing out. We're going to limit our risk on Nvidia, but we're going to give ourselves a lot of upside, much the same, almost the same aspect as Google. Big difference is that Nvidia is a $270 stock, where you have Google that's up around $2,700. And obviously the thing with Google, we actually went all the way out to the stock split with our expiration date because they've announced a 20-for-1 stock split. Amazon came along behind them and also mentioned them. So a lot of interesting things going on in the mega caps. But today we're focused on Nvidia. So based off of this chart and everything that I just said, we're going to look at a long call spread. So I'm going to run to the options playbook now. And I'm going to highlight the long call spread. And now before I get there, I want to let you know that that chat box is opened up. I'm willing to answer any questions that you have today. Please put them in the chat box right now. We'll get to them at the end of the video. If we can, we'll try to address any concerns that you may have on the strategy. And I also have to let you know that none of these are meant to be recommendations. We're trying to learn here. We're trying to take plays inside the options playbook that I authored and address and apply them to certain situations. So we're looking for stocks that may fit the long call spread, if you will, as opposed to just trying to pick that right stock all the time. We're trying to be able to find different strategies that may apply to the underlying stock of the week that we're looking at. So not meant to be a recommendation, but let's get into the actual strategy, knowing that we're going to do a long call spread. So we're going to buy something at the money and we're going to sell something out of the money. Now, the bigger difference when I'm doing a more expensive underlying like Nvidia or Google, I like to try to get my risk reward. I like it to be a little bit more expensive, and I'm going to try to manage my risk reward. I'm going to pay a little and I want to have more upside. So usually it's about a third of the upside my total risk will be. And today we're going to actually look at a 30-point wide spread, and we're looking to pay about $10 for it. So that fits the ratio. We'll have 20 points of upside, and we'll have $10 of risk on the downside for every spread that we do. That would be $1,000 total. So let's get to the strategy. I'm going to run to the Ally Invest option chains, and we see Nvidia is up about 0.5%. I'd really like it to finish even a little bit higher. We'd love to see it finish above the 270, and ideally we'd like it to stay there for a couple of days. And then that gap comes into play on the chart, and hopefully we can get that upside. But we're going to target the top of the gap as far as our long call spread is concerned. I'm going to go out in time. It's a little bit of a longer term play. If we were going to buy 100 shares of Nvidia, you're talking about $26,900 in order to do that. So we are going to take a fraction of that. We're going to try to dip our toes in the water as far as semiconductors are concerned. There are some concerns about demand and being able to fulfill orders right now in this environment. They are still real, but the bottom line is that the demand for semiconductors has never been higher, And a lot that's driving that is the EV, the car space, the changeover from gas vehicles to electric vehicles. So we want to get ahead of that move. I don't necessarily want to go on out and just buy the stock outright and have all that risk. So we're going to approach it by using options to manage the risk. And we got to be very considerate of the strikes that we are buying. Nvidia is going to be announcing earnings. Right now, the forecasted earnings is May 25th. I'm going to avoid the earnings. In Google, we went beyond the stock split because I was anticipating more of maybe a bullish move going into the split. So we wanted to go beyond the stock split. Here we're going to avoid the earnings. I don't want the volatility of the earnings. I'm going to be out of that trade, but we're still going to do a way longer term trade than normal. Now, on a lot of stocks that are a little bit lower priced at sometimes, or a little bit lower, I should say, volatility, we consider just buying a deep in the money call. And I don't mind that. If you're a little bit more bullish on Nvidia and you want to go out a little bit further in time and maybe go deeper in the money and buy that longer term 80 delta option that we've talked about before on the stock play of the day, feel free to do that. This is the way that I think I'm going to take my approach going into the summer season on Nvidia, and it has a lot to do with that gap that we're looking at in the chart. So we're targeting Nvidia possibly filling that gap. You never know, of course. All right, so in this instance, we have the May 20th expiration. Nvidia is trading at 268.46. This is a live show, so these are live quotes. We're going to go and buy the 270 strike and target that high end of that gap, which is right around 300. So we're doing a very big spread, and it's going to be a little bit costly because of that. So we're going 30 points wide on the spread. That's the maximum that the spread can trade for, would be 30 points. At the midpoint right now, we see it trading for $11.30. And we're going out further in time. Now, a lot of times on spreads, if I'm just speculating on a shorter term move and not as big of a move, I would do a shorter term spread because spreads will max out a little bit closer to the expiration date. And to explain that a little bit more, when you sell an option contract, that wants the market to go down. When you buy an option contract, it wants it to go up. We're buying the more expensive one. And these two kind of fight until we get closer to expiration. You're selling an $8, well, at the midpoint, $8.52 option contract. We need some time decay to come out of that option contract in order for this spread to max out. When does time decay go away? Well, as expiration approaches, or if you get way deep into money, like say the stock went to 320, 325, you might see that time decay happen. All right. Now, the good news is that if the market goes against you, this is a good thing. You don't want the time decay to happen, and that premium in that short option contract can actually help you in that scenario. If the market does go down, it gives you a little bit more options to be able to roll it and trade it. But that short call option obviously protects you on the downside because that's what it wants the market to do, go down. All right, so I'm going to put this in the right rail, and then we're going to look at the profit and loss graph. Don't forget to put your questions in the chat box if you have any. So I'm going to click the trade button. That'll put it in the right rail, and this will be the official paper trade for this week. We're looking to buy one of the May 20 270 call options. At the same time, sell to open that same expiration 300 strike call option. And we'll say the midpoint is 1120 right now. So for every 1-by-1 spread that we are doing, we're going to have $1,120 worth of risk plus commissions. Got to add in the commissions on there. And that would be our total risk on that trade. Now, on the upside, the maximum it could trade for is $11. So if you take, $30. If you take 30 minus the net debit that we're looking to pay, $11.20, that means that we have $18.20 worth of upside. So a little bit speculative, hoping for the chart to kind of help us out here today, and we break out a little bit to the upside. That would be a good thing. The markets are looking the strongest that they have in quite some time. I'd love to see that the S&P 500 index has broke above that moving average. So we're semi-interested in the semiconductor space right now. All right, so that's the official paper trade for the week. I am going to close this box, and as you're putting your questions in the chat box, I'm going to open up the profit and loss calculator. All right, we're going to zoom in a little bit on this, and this is what I want to highlight. Okay, we have an expensive underlying that trades at a fairly high implied volatility, right around 45%. So because of that, if we're correct on our forecast right away, we're going to be profitable. Our colored line highlights, as of today, in theory, what the underlying or what your position might be trading for if the stock reaches that high strike of 300. And when I look at this, I will be profitable on that trade if it goes up. This is where our starting point is. This is where the underlying stock is at. But I really need some time decay. So let's dramatically move the days to expiration. Let's go all the way down to 2 days to expiration, and we're going to regraph it. And now you see how much that line has changed. So, well, maybe go to 10 days. Let's say, so we started with we had 59 days. We're going to go down to 10 days. All right. And you see, as expiration approaches, how much more beneficial it is to the long call spread as far as profitability is concerned if you're correct on your forecasts. But I always got to talk about the downside too. That means that we have limited and known risk on the downside. We know what that risk is. But as expiration approaches and I'm incorrect on my forecast, well, it's also going to hurt me worse as expiration approaches. All right. So I'll slide up and we'll look at that workbench, and I'll leave that up. And now I'm going to go and see if you have any questions in that chat box. All right. Clinton asks, hey, Brian, if something unforeseen like a tender offer at 40% above where the stock is at, that's what I'm assuming that means, will our buy and sell both track together? What's the risk? Okay, so you're Clinton, well, that's wonderful if you're thinking that the stock might get bought out. Obviously, that's good for that's just good for the stock in general. But if I go and I look at a 40% buyout, that would be good for a spread, because what's going to probably happen is there's a target price of where the buyout would be at. And a lot of people would be anticipating that that's where the stock is going to go. That would be fairly deep into money. So both of your option contracts, the time value would really decrease. And if you're correct on your forecasts, you want that. You want a lot of intrinsic value in your option contracts. So if that amount, if you're saying 40% higher, you're probably going to see the spread trade very close to the maximum, very close to that 30-point number, which is the width between the strikes, if that stock were to go up to that level. Now, we're not saying that this is a rumor, or no, there's not necessarily a rumor out on it, but that addresses your question, Clinton. Those are Clinton's words, that he's thinking it could get bought out at 40% higher. So do we have any other questions? I see quite a few people out there watching right now. And we still have a few more minutes. So if you want to put a few questions in, that's great. If not, click subscribe, ring the bell. We're going to be here this Friday for the stock play of the day overtime. We have a lot of time for this trade to play out. As a matter of fact, on a couple of the overtimes, we have a lot of time for the Nvidia trade to play out. We also will look at the Google trade. And if there's an adjustment that we can make, I will definitely do that. We will talk about both of these trades, I think, this Friday on the stock play of the day overtime, because they are basically the same strategy but different underlyings. All right, no further questions. Thank you so much for coming. Please share with everybody the stock play of the day. It's free for all. And we'll see you this Friday for the next stock play of the day overtime. Thanks for coming.